Hey, hello everyone. Good afternoon. Uh, thanks for dropping by. I think we have a very good number here. It's very delightful to see this on a afternoon, and the subject is interesting, and we have a interesting set of speakers and topic also. So, as we jump into this, I'd like to call the dignitaries who have come here today, starting with Paul. Paul, why don't you join us? You're a dignitary. Yeah, Paul, all the way from Australia. Right, we have seen enough cricketers. We see Paul here, the risk manager. So, please, Paul. Shikhar, why don't you join us? Shikhar is from HDFC Asset Management. He brings in a lot of weight with the institutional knowledge. He's a product specialist, passive and quant products. Thanks, Shikhar, for dropping in. He has come only for this. And I would like to invite Mr. Ravi, our Vice President. Sir. And also, I would thank Ganesh, my co-chair, for being here. He's been a big help out here. And Ravindran sir, mentor to the Finance Committee, past president of the chamber. Thanks. So, Ravi sir, can I invite you to make the welcome speech and just give a quick intro? Yeah. Sorry, I missed Partha Iyengar. Partha Iyengar has been an old Bangalore hand in the wealth management space and the risk assessment, and he and Paul work together. They have had amazing products over the years, and there is a version 3.0. I think Paul is going to talk about that, the new product, the Phenometrica, the new version of Phenometrica, and I think Partha will be available to chat on the product later as we talk about. I mean, when I say product, I'm talking about the tool which most of us here are money managers, investment managers are looking to create wealth, and these tools are very important. So without further ado, Ravi sir, please.
Very warm good afternoon to all of you. I welcome the eminent speakers for today's fireside chat. Mr. Paul Resnik, founder of Planpron from Australia. Sir, very nice to welcome you. We also have Mr. Shikhar Sethi, Chief Manager of Products and Business Development, HDFC AMC. We also have our Sudeep, who's organized this particular program. It's for the organizers, it's always a challenge to get people to a meeting. First is to organize a meeting, then to get the people. And I think the very fact that we have a full house goes to prove that it's going to be a very interesting, after all, it's all vitamin M. All of us would want to have vitamin M. Now, I also have Mr. Ganesh Swaminathan, also the co-chairman, Ms. Dr. L. Ravindran, our mentor for the banking and financial services. We have our other managing committee members, our chairman, Mr. Om Prakash, and other managing committee members and other members of BCIC. It is both an honor and privilege to welcome all of you for today's meeting. I'm told that investment strategy is essentially a plan that outlines how you will allocate your money across different investment types and asset classes in order to achieve your financial goals. It takes into account your risk tolerance, time horizon, financial objectives, and market conditions. Sometimes I would want to ask you, sir, this share market, the financial market, the gold prices, all these, none of us can understand when it is going up and when it is coming down. In fact, somebody was mentioning all this after Mr. Trump came, the president of US, everything is gone haywire. So how do you factor that? I'm sure any amount of our factoring will not keep us away from the risk. In fact, when it comes to creating an effective investment strategy, combining your investment persona with a well-structured asset allocation plan is essential. By understanding your investment persona, you gain insight into your risk tolerance, time horizon, and financial goals. From there, you can craft an asset allocation strategy that reflects the needs and preferences. I don't think I should talk much about this because we have some experts here who would like to get us an insight into the subject on investment personas and asset allocation. for the benefit of our other members who are here, I would like to share with you that we did have analysis of the union budget, both on direct taxes and indirect taxes recently. We also organized a seminar on direct tax code 2025, which highlighted the salient features of the proposed code. And we had members like Padamchand Kincha, a leading chartered accountant, Mr. P.V. Srinivasan of ex-Wipro, and Mr. K.R. Shikhar of Deloitte, who dissected this particular direct tax code. Another point which I would like to also mention that BCIC has an office in Tokyo, and we are one of our past presidents, Mr. Parshuram, had gone to Japan last week. He was in Osaka, and I think you're all knowing that in Osaka there's going to be a expo in the coming year from June onwards, and we from BCIC are planning to see how we can open an office in Osaka. This is what is the latest news we have. We also, as a chairman of the International Business Committee, we have a lot of programs wherein delegations which come from various countries and ambassadors and trade commissioners, we do host them as part of our International Business Committee. And I'm happy to inform you that recently we had the ambassador of Tajikistan, where we met him, and they are having one jewelry expo shortly, and they are wanting to have a delegation, members who are interested to come there. And we also had one very good, interesting discussion with the Bahrain Chamber of Commerce Industry, who are part of the Invest India meeting. The ambassador of the Bahrain government to India, and some of the senior members were here. And one of the highlights was no income tax, no capital gains tax, repatriation without any conditions, all that. And also access to the Saudi Arabia. So this is what they wanted us to, in fact, they are looking for investments into their country. Another thing which I thought I should share with you as part of our BCIC programs was a seminar on listing and fundraising opportunities in the GIFT City, which was organized recently with NSE IX and IFSCA. And this particular entity in the GIFT City will allow both unlisted and listed companies, public companies, to list their shares on their two bourses operating in GIFT City. In fact, Mr. Ravindran is leading a delegation to GIFT City to understand how it works. And those of you who are interested can join us. In fact, if you're not aware, any business entity which has an office in GIFT City is totally tax-free. So basically, to be into exports. Another interesting program which is coming forward, shortly is BCIC is organizing one BCIC ESG Awards 2025. This is for the second time. The organizations that demonstrate excellence in environmental, social, and governance practices, and also showcasing innovation and commitment to sustainability can apply. The last date for registration is 18th of March 2025, and those companies or organizations who are interested can visit the BCIC website for further information. I always request those of you who are not members, please do so, because we would like you to be a part of BCIC and participate in more and more programs like these. In fact, we are on the 48th year, and in the year 26-27, BCIC is going to celebrate its Golden Jubilee year. And that would be a very special year, and we would like all of you to be a part of this. I would like to thank you one and all for being here, and I'm very sure the members present here will very greatly benefit from the investment advice of the very eminent speakers who have gathered here. Thank you very much.
So thank you. We'll start the fireside chat. So I'll stand here and talk. I think that will be. So just to preamble, this question is for everyone. What do you think? Check. Is this clear now? I think I'm better off here. Yeah. Okay. What is that one thing, one of the things perhaps, which causes immense trauma to the human mind? Anybody wants to volunteer? Go ahead. What part? Okay. Yeah, you're close, but I can give a clue. Howard Marks was talking about this in his latest video, the podcast. Okay. In the interest of time, I'll just sneak on this. He says, nothing is more bearing on a human mind than seeing somebody known to him making a lot of money. Right? The envy, the 7 sins, the envy comes out. Either it is your wife telling, look at that guy. How did he make that? And you are there. Or your parents coming and tell you. So next, what are you going to do? You're going to find out what he did. He bought a plot in Bangalore, or he bought an apartment in Bombay, or some stock or some crypto or whatever. You're going to do that, right? Well, this is perhaps one of the first mistake, and I think most of us are financial advisors here. We know it, but without knowing, we get into this. I think this was what led me to talk this, have this session, investment persona. I didn't want to use the word risk because risk has that negative connotation. We don't want to talk about risk. Oh no, I don't take risk. I hate risk and all those things. But investment persona, you are going to go do something else because the person you know did a lot of money and you want to go chase that dream which is not yours. So I think this is all about, Paul, do you agree with that? You want to give a addition to what Howard Marks said? You agree on this bit?
I started in this industry 50 odd years ago. And I think I may be the only person other than Howard Marks who's still around. Investment is psychology, yeah? I can make money out of this decision, or I'll stop the pain out of this decision. That's buying and selling. When we look at the data, the more often you buy and sell, the more fees you pay, the more taxes you incur, more confused you get. So once you're sort of caught in this dopamine chase, if you're a trader. The dopamine, I've got to do it. You make a decision. Now, every piece of data I can find is this not a way to wealth. This is a way to keep yourself entertained. Now, you're very unfortunate or fortunate here not to have TikTok. TikTok gives you dopamine, and it is a better way to spend your time than trading. Okay, now, if you're in the financial services industry, you need to decide who your client is. We talk about triage. You want people to work with you that meet your service. So if you're running a trading business, you need to provide flashing lights and regular reporting instantly. I made the decision, I can see my profit, I can look every 10 seconds to see the market move. You want those sorts of people to be in that space. At the other end, you want people who are at another state are conscientious and are prepared to listen that other people know the way, to say wealth is created at the investment level slowly. All of the historical data shows if you've protected the downside by diversification, things go up and down, but in the end, 6% over inflation in every country I can get long-term data is about the right number. So, my place in the midst of all of this is I watch everybody say, Trump is in power, the world has come to an end, or it is just at the beginning, depending on your view of Mr. Trump. And then you look at whatever it is, the 30-year data that you've got, and the markets move 5% or 4%, and the world is at an end. So how do you deal with that? Well, you can find that out by understanding people's psychology. And that's the space I've been working in for the last 30 years. The markets will go up and down. You'll never know why, but people will tell you they know why. And you know this issue, always the journalists know the following day. Yeah?
So Paul, just to come in there, so risk is not essentially all the numbers these smart people talk about. It is about envy, greed, and fear, right? So it's a lot more behavioral, right? So can you give us a 101? Like, there are a lot of people who might be beginners. So Paul, you've been, for people who are not familiar, I was doing some research and he's been called the godfather of risk measurement. My God. Yeah. Godfather. So what got you that moniker?
All the others that were competing.
So Paul, just a 101 on risk measurement.
Yeah.
So because the basic level.
Yeah, basic level.
And I'll cut you, as you told me, if you're going.
Yeah. Very simple. There are three sorts of people. Ones who are unbelievably risk averse, ones that are unbelievably risk following. They like the endorphins, and the vast majority of people that find all of this really tedious, and they want to get on with their lives and know that the assets are available when they need them to meet their liabilities. So my work is essentially helping people find where they sit. It's a bell curve, and if you're at one extreme or the other, you're going to be vulnerable. If you're at the bottom, markets move against you, you'll be terrified. If you're at the top end and you're not fully invested, you'll be pissed off. Why did somebody tell me not to get fully invested? So my work is predominantly finding out where you are, and I'm an accountant, as we talked about before. This is only asset liability matching. I want to have a reasonable chance the assets will be available to meet the liability as it falls due. And that's the algorithm of financial advice. Risk tolerance is your psychological pain. It is not the determinant of your portfolio, but it's the good starting point to a discussion. If you're low risk tolerant, you can show somebody, well, here is a traditional Indian portfolio. Your gold, your property, your term deposit. What will it look like if you take a little bit of risk, a little bit of equity into that? What is that likely to do? What does the history tell us? Because the best predictor of the future is the past. So knowing somebody's risk tolerance is helpful. If they're in a couple, it's even more interesting because they're likely to be different. If they're in a family, it'll be all over the place. And if it's between generations, it will be all sorts of things that are different in terms of their values, biases, and goals. So in the end, it is a collaboration. We have called our business plan prompt because there isn't a right answer, but we can prompt a discussion with the tools we've developed. They're just questions that say, compared to others, this is where you are.
A little nudge.
A little nudge.
Yeah.
Let's talk about it.
Yeah. So essentially, the essence of investing or the core of investing is know yourself first. Yeah. Then learn everything else. Yeah. So Shikhar, you want to just jump in and say, like, you are a large asset management company, so you will have a large data set. I'm talking within India, like Paul has got a global view. So you agree with that? Like, there is a lot of behavioral pattern which comes in, like, when we are talking about investing. Because I know about the 2% of the people staying in the long run. You want to just elaborate on that?
Yes, so would definitely agree, with what has been shared so far, that it is, as much as you can try and educate investors, at the end of the day, it is still very emotion driven. You see this it manifests itself in many, many ways. For example, why do markets have momentum? It's exactly this, right? When things are going up, then what Paul was describing, more and more people tend to think they're on the right side of the bell curve, and they start entering, pushing it up more, so on and so forth. People who are on the sidelines also get pulled in, So our job as an AMC is to sort of cater to everyone on the sort of risk spectrum. Vast majority of our investors will either be in the middle or on the left side. For the right side, there's always the casino, not an AMC, or crypto, which is the casino now. But from what we try and do is that, yes, we do have, for example, on our website, a risk profiler. So it may not be as, I doubt, anywhere close to as detailed as what Paul has developed, but it's a very good starting point, for new investors or even people who've been doing this but never really asked themselves those questions, that actually, what is my risk tolerance? What am I willing to lose to make what I want? And you sort of, at the end you get your, profile. Like, are you conservative, moderate, or aggressive? And with that, I think it again then sets the stage for a further discussion with our MFD or RIA partners. Because, there's only so much that a piece of information on the screen can tell you. It's very important you get that sort of personal touch as well. Because sometimes we find many cases it's very easy in theory. You say, okay, what kind of drawdown can you handle? -10, -20, -33, -50. People may be, saying, okay, -33, -50, but a sort of MFD RIA will caution you, saying if you think that's your actual risk appetite, in reality is going to be half of that. That's one thing. Second thing is living.
These things are really working these days. Like, maybe 10 years ago, we never had this kind of thinking, right? Like,
correct,
I think
correct.
there are a lot of people from my generation.
Correct.
So even if we knew a little bit, it was not application oriented.
No.
But today you are seeing actual implementation.
Definitely. And second way just to complete that point is that, the other way to know your risk tolerance is to live through it. You actually see that drawdown.
There are a lot of people who have lived through it. That's why they're here.
Correct. And then you learn and you sort of adapt for the next cycle. But yeah, as an institution, so we sort of offer this service. We also, do maintain a database, basically, so we have a big internal database on who's transacting, when are they transacting, so we have a digital team which looks at patterns in that data. And, sometimes we use that for maybe...
Got it. Yeah.
Exactly.
I got the drift of it. Thanks. Partha, I don't think they have a plan prompt. You should be giving it to them. HDFC is on our call list. So,
check the risk profile.
Okay.
So anyway,
Very
that's
interesting.
Yeah.
We can do a lot.
So Paul. So essentially, you are telling, we are talking about emotions out here, about risk assessment, right? Risk measurement. So what you are doing is putting numbers to this, right? And telling Voila, here is your risk number or whatever profile. So can you just very briefly say, how this gets crunched? And after that, you mentioned about tail risk. I'll come to that question to both of you. But if you can just, how the emotion gets into the number and comes out as another.
So, your past behavior, like the markets, past behavior is a good predictor of future behavior for individuals and markets. Yeah? If you know somebody for a long time and they misbehave on Friday night at dinner, you know they're going to misbehave unless you give them a clout. Yeah? So we know that when we ask people questions, we're not trying to find something deep in their brain. We're trying to explore what did they last do in similar circumstances. Yeah. So we're trying to say, compared to others, this is where you are. Taking from that, we can go to the two other questions that you raised. If you invested consistent with your risk tolerance, the answers you gave, we can basically say there's a range of possible outcomes for a diversified portfolio. And I use diversified because it is the right place to start if you want to achieve goals. The more concentrated your investments are, the more likely you'll get greater volatility. Now, it may be that in the conversation, somebody says, I don't believe you. I want to stay gambling in the market. So they will say, I've been to a trading course, yeah? And they've showed me if I follow these 10 signals, and you've seen them on a screen, there's a red one. It sort of looks like gamification. You've gamified to get that dopamine kick. So what we do is we start at the safest end and say, this is the asset allocation. So very simply we'd say, if you started with a small exposure to a diversified liquid assets, and we'd always start with liquid. Illiquid assets are never available when you need them.
So just for the people who are not familiar, what the risk assessment tools generally, whether it is Plan Prompt or the one HDFC has, is it has a set of questions. It could be a dozen or 20 odd questions, which kind of quizzes you in multiple forms to get your what's in your head. And this gets processed as a number, where your risk
ability is. Like, there are essentially, Paul and Shikhar, you can say, there are 3 things broadly in risk, right? Your ability to take risk, willingness to take risk, and need to take risk. I think it's like your ability is like, you can jump from the 10th floor, but you have a willingness, but is there a need? Like, it goes back to that, like, when it comes to investing also, right? I think this is what in English, this is what the math does, right? So, you want to add something to that?
Just to simplify it, we can tell you this is the asset allocation that's sensible with being sensible. It may not be the right one for you for other reasons. You may have huge liabilities ahead, you need to take risk. Or you might say, I don't need to take any risk at all because feeling the pain, the actual pain, I don't want to ever do. So it's an ongoing collaboration between the investor and the technology, if you try to do it that way, or a human. This is the hardest thing, I think, to actually robotize. I use the word cyborg. The tools you want is a human to have the information available to respond to the person as they are in the language they would prefer. And that's the secret of suitability.
Yeah, asset allocation here refers to the risky and non-risky, like, that's the equity and bond allocation. And for the corporate treasury guys, it would be a decision of whether I should invest for 1 day or like 10 days or 15 days or whatever it might be your duration. So broadly, this is what it captures. So I'll go a little technical because Paul, you told about the tail risk. Like, so how do you look at this tail risk? Like, the extreme events, because they keep happening.
Yeah, well, it's about day risks happen, and if you care about them, they'll bite you. Yeah. So I smile when I talk about day risks. That's when you're obsessed with looking, obsessed with reading. When you look at the market, it goes up at 6%, give or take. Every 10 years, it grows at 6%. It does it in all countries. I don't know why it does that. I can only tell you it does. The more often you look, the more unhappy you will be. So I pay no attention to day trading. I pay no attention to Donald Trump. I find it entertaining. I love this notion of emptying the swamp. This is more, I like the English and the emotional language, but in the end, it'll solve itself, yeah? These are not real risks. So day trading is for people that need the dopamine.
Okay. So a question for both of you from your global perspective. Paul, like, just to put a number, you have the Phenometrica tool has assessed how many individuals? Just to...
Yeah, when I sold Phenometrica, we've done 1.6, 1.7 million tests.
That's the data set they have, right? 1.7 million individuals, institutions, they have done their evaluation, and the data set, like, it keeps growing. Like, that means it gets deeper and deeper, like, and more precise as the number increases. So, my question is, what are the common mistakes investors make? Like, how do you course correct? Like, you can add from an Indian perspective from your data set. Paul, from that vast 1.6 million.
I guess being impatient. If you've managed to get yourself to have a plan, you need to get to Delhi. You have multiple ways of getting there. You can decide whether you're going to walk, go on a donkey, catch a plane. Air India, I believe, is more reliable now, yeah. So there's multiple ways to get somewhere. You need to have a goal in mind, because goal gives you dopamine, yeah? If you know you've got something that's important to you, rather than being abstract. I want to have, if it's retirement, I want to be able to live well. Money only does one thing. It gives you choice. In the end, it just gives you choice. Without money, your choices are limited. So, if you can manage it, if you have something in you that allows you to plan, start a plan and stick to it. There is nothing else I have ever seen that works better in terms of likelihood of good outcomes for more people. It is possible that you will be the person that gets everything wrong. Yeah, you start at the wrong time, you get out at the wrong time. But in terms of statistical likelihood, that's the safest way to proceed.
Paul, plans don't work. I started a diet this morning. So what's the plan B?
Plan B, gamble away. Are you a trader? You find yourself an advisor. This is the second.
So there is no plan B.
Well, the plan B is if you can't do it yourself, you have to have somebody you respect. Okay. So to do that, you have to have respect for authority. Okay. This is personality. If you have no respect for authority, who are you going to follow? You go to Reddit. You have Reddit here? You
Yep.
read what's in Reddit. I like this person, and you follow that, and you see what happens. Yeah. There is authority that works, and it is about being exposed to good assets in the longer term, as diversified as you can make it, paying the lowest fees with the lowest level of trading, because that causes frictions. That's what the evidence says. Now, there are aberrations everywhere, and this is one of the problems of recency bias and what are your friends doing. If everybody follows each other, then the moment somebody says...
The momentum thing which you was talking about.
Yeah. So Musk is going down. Is this a good time to buy Tesla or not? Yeah. And when will we find out? Yeah.
Yeah. Talking about authority, I think the advisors here, the treasurers here, and of course to answer for everybody's behalf, the asset management company. So how do you deal with that habit problem?
I think just to actually answer your first question, what sort of goes wrong? So we noticed two things, two main sort of errors. One is you either don't have a plan or you don't stick to the plan you made. Don't have a plan is very common for first-time investors. Friends are putting their money, they are making tons of money, so I put my money. I have no sort of sense of my risk appetite, what I'm doing, where we are in the market cycle, all secondary. I just see, as you mentioned, the biggest pain is seeing someone else make more money. So that's troublesome, because then they face the drawdowns, and then they again tend to sort of redeem at the wrong times and panic and then think this is not for them, or say this is rigged, or go down the other emotional extreme. So that's the first kind of people who don't have a plan. Second is the ones who don't stick to a plan, and that we find that sometimes if you're lucky, when you start investing, you may have a good 2-3 year period, right? So you're then you start mentally accounting for those good returns. And somewhere down the line, when the drawdown eventually comes, you suddenly find that what you were maybe compounding 15-16% on has now become flat or even negative. So somehow people just aren't able to internalize that. They feel that something has gone completely wrong, and then they again panic at the worst possible moment. So these are, the first one beyond a point can't really be solved. Sometimes some people are just a little impulsive. We can put all the tools out there, but it's for people to also read them. The second one is again where a person whose authority you respect steps in, maybe shows you the data, maybe tells you that, look, this is not out of the ordinary. What you're experiencing is very normal. It has happened in the past. It will happen again in the future. So no need to freak out. Just stay the course. Stick to your plan, and if you have any extra money, if valuations are sort of in the comfort zone, then look to add more. So that's by and large, we also create a lot of content and distribute it to our partners. So those are sort of the messages we try and reiterate, and then at the more granular level, it's sort of reinforced by the MFDs and RIAs.
No, in fact, there is an amazing making a plan and staying with a plan. HDFC has a wonderful example which their CIO used to often quote. They have these two funds which had done a tenure of 2 decades, 20% plus returns.
Correct.
Right? And guess how many percentage of investors actually enjoyed 20% compounding is mind-blowing, right? We are talking about a PPF giving 8%, and what happens in 15 years.
Sorry, I just correct you, it's 30 years.
30 years.
Yeah,
30 years,
3 decades.
And 22% compounding. Just to make it quick, only 2% of the investors stayed during the entire tenure. And that shows what 98% They were in and out, all the three behavioral problems, like, they would have faced, like, they would be going and coming out, and then blame the market, blame the advisors, blame the government, blame Trump, blame everyone except themselves. So know yourself first. Like, I think you want to add something on the data? I think that's the big number.
No, it's yeah, no, I think this is a very, good data point, and you can look at it in many different forms. You'll see, if this bear market, at least historically, we don't have the chart right here, but you definitely see, inflows/outflows accelerate during downturns, and the inflows accelerate during big upswings. So this is just psychology. Even if it's not rational to be doing what people are doing, people do it because either they don't know better or they're genuinely just gripped.
Because the next cube guy made more money.
Sorry?
The guy in the next cubicle made more money.
It's just greed and fear. That is, what is happening, and therefore you need to, work with yourself. If that is insufficient, work with your advisor to figure out, what your risk profile is, what you can tolerate, and also what you should expect. Because, just looking at the last, that's what the most seasoned investors, like they just don't get phased anymore because they're like, dekha hai, dekhenge aur bhi. But it's the new ones who tend to actually make some of the, these mistakes. So they often are the least likely to go for advice because they are just relying at this stage maybe on social media or their friends, so on and so forth. So that's one thing to...
Yeah. So, Paul, I mean, if you go back, like, probably when you started your career, there are a lot of people from that batch, and even including us, like, we are a few years behind you. One of the simple risk management tools which was taught to us was from portfolio, the policy portfolio, right? The 60-40. You just do it, forget it. Like, as Indians say, fill it, shut it, forget it. Nothing's going to happen. But today there is this noise. Policy portfolio is dead. Is it? We would love your perspective. I mean, it's a simple question, but it's a loaded answer, and you can go on. But
I'm very naive.
Yes.
I'm very lazy. So I have some simple rules. I don't like private equity. I don't like private credit. Okay, do I use both? Yeah, my business, I set up businesses. I live the entrepreneur's life. It is terrifying. I can't pay my bills this Thursday. What do? Oh, my bank couldn't care anything to help me. Yeah, that's what happens. Now, at various stages, a private equity is like that. When you need to have liquidity, it's never there. So, I go back to, given liquidity and my options, it would be liquid assets making up the vast majority of the portfolio, and it would be risky assets for the thing that is inconsequential. I don't mind if it's bad, but I really want the kick. Yeah, I want to know I doubled my money over the weekend. Yeah, or I went on holiday and I came back and it's dropped 60%. There's lots of things like that. So it is common sense in a sense. So I'm a 60-40 man, and have been. I have huge arguments with my English business partner. He tells me 60-40 is dead, and I say just wait a few weeks, and it will, because what happens is things correlate on the way down. They don't correlate on the way up. And so if you're not trading, so I'm a firm believer in, though there is nonsense in momentum, momentum is the only thing that has value. That's the sadness of, I loathe the notion that you don't do anything useful with your money by investing in big cap businesses. But if that's the preference in terms of your goals and values. But if you want returns, that's where you hang out. If your goals and values get over the top, you're adding risk. That's the collaboration, that's the prompting, that's the intergenerational piece that you need to navigate.
So 60-40 is not dead, it's not going anywhere, it's right here. You want to add on that? I know you guys have been doing a lot of work on that. You call it different names, balanced fund, etc., etc.
Correct. So the hybrids category. So I mean, I'd just answer that more from Indian markets perspective.
Yes.
So I think, there's still a very long runway for that to work in India. The reason being, obviously, no need to sort of reiterate the equity growth story that India should still enjoy. But unlike, let's say the US or other DMs where you had that situation where the 40, your bond portfolio was basically either yielding 1.5 or negative, you still have a very good, healthy 6.5 to 8-ish range for your bonds in India. So even in a sort of, non-interest rate, cutting world, just from that, just from the stability, just from the coupons that you get from your bonds, that is itself, it's sort of weight in gold, pun unintended, for the portfolio. But I would add that in India, like it is still a good, sort of probably good policy to have some amount, not just in equities and bonds. That will still do quite well, but also gold. So not just because gold has been doing well recently, but because gold genuinely offers something that bonds don't, which is that if you are ever, right now it seems like a distant memory, but if you remember 2013 and we were one of the fragile 5, that was not a nice time to be in bonds, but gold and the currency gave you some protection. Now our macro is much better since then. There's no sort of imminent reason to, like how in the US you have fears of too much supply of bonds. You don't have anything like that in India, but the future is by definition unknowable. So, keeping this diversified portfolio, not sticking completely, equity and bonds should do fine, but if you want that little extra protection, a little bit more sort of, protection against tail risks, then gold I think also should be part of the portfolio. And that simple strategy should be good enough to, in fact, solve most investors' return requirements without providing too much volatility. So very simple strategy, very easy to implement, and should really go a long way in just helping people meet their financial goals.
Yeah. Thanks, man. 60-40 for people who might not be familiar is creating a portfolio of 60% in equity and 40% in debt. So you kind of continue that portfolio, and when the equity increases, you rebalance. Equity becomes 70%, you rebalance back to debt and vice versa. So that's what it is. So that brings to another quick question, the correlation risk, right? I think you kind of answered that question, but I'll still pop it out there. In a crisis, all of them move together, right? So how do you deal with this?
My argument is that you need people to understand volatility. Okay, the critical issue is something called sequence risk. So sequence risk is that the time you're trying to take money out to meet your liabilities, the market is in correction. So this is particularly for people who don't have a greater deal of money. They have no other resources. They can't borrow against their house, they can't move in with their kids, and so there's a whole series of things. If you're caught in a sequence risk, and you'll never know, of course, till afterwards, but if you see you're going to be selling down to meet your liabilities, once again, you can do it yourself or you work with an advisor to get through. So I really don't, this is an educational issue. How do you deal with it? You play, I have this cliche that's grown out of COVID. You play the cards you've got, and you do that as coherently as you can. If you want to do it yourself and you're disagreeable, you will find lots of people will give you advice that isn't based on long-term history. History is our only friend.
So there's no free lunch, right? You need to educate yourself. You can't ask that cousin or uncle,
There's a pretty decent brunch, which is just being disciplined, or finding somebody to help you be disciplined. Yeah.
Yeah. Thanks, Paul. Shikhar, I wanted to ask you, because you have been a product specialist on indexing, can you just add some light on how indexing can be used as a risk mitigating mechanism? So before you tell that, maybe there are a lot of freshers, just quick 101 on what indexing is, and just if you can go in quickly on that.
Okay, so what is indexing? So the way to understand indexing is that you have a fund which is tracking an index. So just let's give an example, to make it very simple. Everyone knows what the Nifty and the Sensex is, right? You look at it on the news, it's everywhere. So indexing just says that I will invest, instead of just seeing it on the news, I will actually invest in the Nifty or the Sensex, which means my fund manager on my behalf will be buying the same 50 stocks in the Nifty 50 and in the same weights, right? So I don't have someone who's sitting and saying, okay, of the 50 stocks, I like these 10 the best, so I'm going to buy more of them. I hate these 20, so I'm not going to buy them. You're buying the market, right? Hence, your expectation should be market-linked returns. So that is indexing. I've explained it in equities because we are almost familiar with Nifty, Sensex, so on and so forth. The concept applies across asset classes. So I can do indexing on a debt, right? So I have all these, target maturity indices, constant maturity indices. Like I can just buy the equivalent of a 10-year government bond, in a passive fund format. So that's what indexing is. It's an index. Index is just replicating or basically tracking the performance of a particular asset, and it's rules based. And indexing is when you have a fund which is tracking the index. The advantage of indexing is that it's very simple to understand. It's generally because you don't need, you need to have very good operations, but you don't necessarily need a very experienced fund manager and an army of analysts, so it can be considerably low cost. And the third thing is the transparency. So you know what you get. If you read the index methodology or someone explains it to you, you know that, these are the rules, this is what the index is going to do. So you can base and create some sort of expectations around it, right? So I think what's been very interesting in India is that in the last 3 to 5 years, the range of passive products that has become available is basically let you do, you can create an entire multi-asset portfolio now just with passive products. So that lets you both increase or decrease your risk as the case may be. So, let's take some tangible examples. So, okay, how can you decrease your risk? So one is that up till now, because index funds were not so prevalent, most investors have been investing in active funds, right? Nothing wrong with that. But as you all know, that fund selection then becomes quite important. Why? Because in any given year, and you can look at the data through this, the gap between, let's say, the best and the worst performing fund can be quite large. Furthermore, there are many instances in which a fund which has done well does not continue to do well, right? So you run a risk where, yes, you have equity exposure, but you may still not be capturing all of the market upside. So one way to protect against these very wide range of outcomes that can happen with an active only portfolio is to include indexing. So, you can say, okay, so-and-so fund manager, I see his interviews or her interviews, I really like their style. Let me give them 70% of my money, but the 30% I'll put in a Nifty 50 index fund or, a Nifty large mid-cap 250 index fund. So what happens is that if your active fund does well, great, 70% or 50%, whatever you feel is right, is giving you that kicker, you're beating the market. If it doesn't do well, your market-linked returns are coming from your index portfolio, right? So in that sense, it sort of mitigates the risk of having a very wide range of outcomes amongst your active portfolio. You can reduce that risk to some extent by diversification between active and passive, right? That's the first. Second is, even within equities, there are a few strategies which let you sort of capture the market upside, but during, stress market conditions or severe market falls, historically, they have given you some protection from very severe drawdowns. So one of these, for example, it's a smart beta strategy called the Nifty 100 Low Volatility 30 Index. And what this does is it chooses the 30 least volatile stocks from the Nifty 100 index. And what we've seen, we sort of have a presentation and crunched the numbers. We've seen it historically, and I will admit, some of this is the back-tested data. But we've noticed that in terms of return capture, it's very similar to what the Nifty 100 gives you. But on the downside, when there have been significant market sell-offs, anywhere between 6 to 15 percentage points you've saved in terms of drawdown. And as Paul mentioned, and even Buffett has said this many times, to make money you have to not lose money. So if you can keep your drawdowns to a minimum, that's a sort of very good trade to have in a portfolio. That's on the equity side, right? On the debt side, there's a sort of, it had been introduced some years ago. It got quite big before the tax rules changed. But there are these instruments called target maturity funds. So here, it's very useful, especially for, a corporate treasurer or anyone who knows they need a cash flow at a certain period of time. These funds, the way they basically, if you need, let's say, your money in 2032, you can buy a target maturity fund of that maturity, and it, on your behalf, is investing in bonds which mature around that same time, right? So the beauty is that you kind of have some idea of what return you can get, because a very good proxy of that will be today's yield to maturity. And unlike other kinds of debt funds where at maturity you don't exactly know what the value will be, with a target maturity fund you have a pretty good idea. So this massively helps you reduce your interest rate risk at the time of maturity when you need that money. So let's say you're a retiree and you need that money in 10 years. You say, okay, I'll be conservative. I'll buy, just a 10-year, I'll buy a long duration debt fund or a gilt fund or whatever it is, because, it's safe. But what you don't realize is that in 10 years time, in case at the time you need the money for your retirement, interest rates have shot up, 200 bips, you will be at a pretty nasty position in your portfolio. That risk is mitigated to a large extent by these target maturity funds, which are a debt example of indexing.
So, sorry, to cut you short, can I summarize this a little bit? So what essentially he's telling is, instead of going out and buying, say, 10 mutual funds or 50 stocks, you select 2 or 3 indexes which take a market exposure. So essentially you're making less decisions. The more decisions you make, the probability of making mistakes are higher, right, Paul? That's what happens, right? So you're minimizing that. So effectively by that and by reducing taxes because you're not coming in and out, I think this is a big saving also.
Exactly.
Right?
You have very small portfolios. Like I said, now you can, each asset class, whether it's equity, debt, commodities, international equities, liquid, for cash management, you have a passive for everything. So you can just, choose your allocation, choose one fund in each category, and you're good to go.
Yeah. Paul, just a quick thing, after this I'll take the audience question. So from your macro global view, there is always this debate of passive and active. You want to get into that?
Yeah, I love
it.
Thank you.
Please. Yep.
So,
he loves this.
Everybody loves a story. Yeah. And financial services is the best storytellers on the planet. Hollywood is long way behind. Bollywood even more. Everybody loves a story. I was blessed to be in the industry with some of the best storytellers.
Yeah.
And I ran a conference business for 3 years. And it was magical. The first year, these guys understand everything. This is how their theme is going to reveal returns beyond comprehension. None of them were around 5 years later. Yeah. So, I'm a firm, I use my data piece, which is a thing called SPIVA.
Yep.
You may have come across it. S&P is an index, and they look at the returns of the index versus managers in that group. So there's an Indian one, an Australian one, a US one, and they look at the number of funds that underperform the index 3 months in little tranches out to 10 years in India and 15 years in other places. And you just look at that and you think, in some places it's not bad. It's 50 or 60% of funds underperform. In others it's 90. So the challenge is just an evidence-based one. If you decide not to, how do you decide which one is an active manager that's going to outperform? And when do you decide to get out? So when you've got a formula to do that, then you play that. If it's play money, and you're just going to say, I watch the news and I can see how bad things are on the border with Pakistan, the market's going to crash, or it's going to go up because army spending will go through the roof. We can make... So I'm afraid I have this terrible problem. I'm a small businessman that lives every day for the joy of small business, but I suspend my belief on the data. Passive gives you the starting point and the core, and you play around that.
Yeah. In God we believe, but everything else, data. Yeah. Thanks, Shikhar. Thanks, Paul. And I open the question to the audience.
Can you explain what does your product does actually?
What does my product do? Yeah. My product helps people understand themselves.
You want to do it?
So if I summarized it, we have a series of questions. Takes maybe 10, 15 minutes, and it reveals what's in people's heads. So if I just run through it quickly, we have a risk tolerance test, and that is a bell curve. Typically people are high and low. We have a knowledge and experience test. So people can say, I know something or I don't. So if you have a naive investor with no experience and no knowledge, maybe you manage that person more carefully, because you hope they're telling you the truth. People have biases. Yeah, recency bias, don't want to invest for the long term. There's I think 150 biases. We discover those biases. They may or may not influence people, but that's revealed in our questions. We also have a thing called the Big Five personality traits, which you may have come across. The acronym is OCEAN. O is for openness. So if somebody is open, they're likely to be interested in spectacular opportunities. If somebody is closed, they're likely to be conservative. So it's good to know what you're dealing with. C is almost the opposite. It's conscientiousness. A high C is somebody that's going to follow very carefully. A low C is somebody, if they're a big O, are going to just say, I read this, I saw it on Reddit. In my case, I saw it on TikTok, and it looks like a... E is for extroversion. Extroversion is being social and learning from others. The opposite of that is you make up your own mind with whatever stuff you've got in it. A is for agreeableness. So disagreeable people, and you all know them, you never want as clients. You know, they're always arguing with you. If you're really unfortunate, you've married one. Yeah? Your mother-in-law is one. So you know their behaviour. Whatever you say, you go, I had a great day, and they'll say, I know the story. I got 98 in the test, and they beat you up, yeah? You weren't good enough. Yeah. You wasted 2 points. And the last one is a clumsy term. It's called neuroticism. And it literally is close to that. A low neurotic person remains reasonably calm when things go wrong. A high neurotic person is likely to get emotionally caught up. So our test gets all of this stuff out so you can have a conversation with a client. Because we go back to, I can hyper-personalize that person, so you can, as an advisor, hyper-personalize the relevant portfolio. Yeah? And it could be, and the starting point is wherever every advisor has their own biases. And sometimes they're a fiduciary bias or low fiduciary. So fiduciary is the client is the only thing I get paid by my client. The other is I get paid and I've got to feed my family. We all have to navigate that. I talk about having a fiduciary mindset, even if you're you're in the transaction space. So if that gives you, I've taken everything I know out of 50 years and reduced it to the inputs for you to have meaningful conversations in ways you could talk with somebody who has a financial issue. Originally designed for individual advisors and their clients, but increasingly as I talk to people working in money, insights into your 10 best clients might be a nice session to do so they can understand you, because you're likely to be highly conscientious, otherwise you would have been thrown out of the chartered account, but they're not. To see what the thing, and for families, I just did one, I'm sorry, this last bit. I just did a family that called me in. They, just to give you a sense, they had 200 million US, so reasonable family. The money had come from the father, there were 2 kids, and I got the advisor, the lawyer, and the accountant. I put them all through this, and we worked our way through to see, were they the right mix? So this is very confronting for the advisors. Were they the right mix for the patriarch? And what were the gaps? And the fascinating piece in this was all of the money was in safe assets, and over the last 5 years he'd blown huge amounts on crypto mining and property development. And so everything was safe. And so I was able to say, if you, and you'll know this term, if you equitize half of your cash, that you know you've got waiting, and you've got the other half in cash, in this case, let's say 100 million, you'll get the equity returns out of an ETF at no cost, which is give or take 3 or 4% better. As long as the liabilities, you've got the cash there if you have the liabilities. So it was a way of saying, in where you found yourself, unfortunately you've come from a culture that's chasing returns, but we call it a barbell approach, and I guess it could well be a particular style in India as well.
No, barbell is the
classic
expression, yes.
Yeah, so that's what that process was. It took very little time, quite confronting for the advisors. They were going, wow, we might lose the client, but because he had a low end, he was very happy to be patient and said, yeah, this is a long-term plan for us to diversify.
Can you put it on the screen? Yeah. Actually, if you
can go for short or long.
Okay. If you guys are keen, we can just do a short test, actually run it on the screen. We'll need a volunteer. Partha, you want to run it?
Yeah.
You're ready?
Yeah.
There's a volunteer already. I just put it, I just had a fun, what is risk profiling? Take a deep look. A good picture speaks 1,000 words. So anybody wants to volunteer? Ganesh? Morning, sir.
It's fun. It's fun totally.
It's fun.
And there's no embarrassment.
I won't embarrass you, watch.
He might do that. There's no guarantee.
Okay, Ganesh is volunteering. Partha? Yeah, for all the young folks here, a product demo is better than 1,000
Yes.
presentations. Yeah, just write GT short form, so. Push up.
So I will read them out as we go.
Announce.
I'll read them out for those.
Announce.
First question, I consider myself someone who is open to exploring new and unconventional investment opportunities. There are 5 choices and you only have 1 second to answer.
No, just go ahead and do it. Just for
I'm
fun.
willing to take financial risks to achieve higher returns. I enjoy learning about new financial products and strategies. I thoroughly research and plan before making any financial decisions. This is difficult for a chartered accountant. I keep track of my spending and adhere to a budget. I regularly review and adjust my financial plans. I enjoy discussing and sharing investment ideas with others. I feel energized by networking and attending financial seminars or workshops like this.
No, Ganesh.
I often talk...
He's the organizer.
I often talk to friends and family about financial matters. This is a man on the fence. It's very sore. Very sore. Yeah. I tend to trust financial advisors and experts when making investment decisions.
You're enjoying it.
Yeah, he's rebellious.
Because I told you I'm very confident.
Yeah, overconfident. I can say I often take advice from friends or family regarding financial decisions. I believe in sharing financial success and supporting others with my knowledge. I often feel anxious about the potential losses in my investments. I tend to worry a lot about my financial future. I get stressed when I think about managing my finances. Okay, press the button at the bottom.
After this, you click that purple button, sir. That's the next test. That's a risk tolerance test and risk appetite.
How do you think the general economic situation will develop in the next 12 months? I plan to begin taking money from my investments in less than a year, all the way up to 10 years.
This has to be very influential.
Yeah, you can just take a random thing. It's okay, just to...
We're not asking you to think, behave like an accountant. It's very rude. When it comes to investing, I would describe myself as very experienced, somewhat experienced.
I mean, as we are talking, right, know yourself. This is actually
How
knowing
confident
yourself.
are you in your ability to choose the right investment products? Which of the following best describes your approach to financial planning? I plan carefully all the way down to I don't have a plan. You have $100 in a savings account and the interest rate is 2% per year. How much will you have in the account at the end of 5 years? Here's numerate. Buying a single company share usually provides a safer return than a collection of shares in multiple companies. How do you feel about taking financial risks to achieve potentially higher returns?
It's all about which one's perception, it's behaviors, there's no right or wrong. And let's give safe space to the volunteer. He's being brave. We need to give space, and we need to appreciate that he has taken the effort on so many.
When faced with an unexpected expense, how do you typically respond? Use savings, use credit cards, take out a loan. Imagine you have the following options for financial gain. This is asking you to calculate. This is very painful to watch.
Yeah.
What would you select? You want $1,000 for certain, a 50% chance of gaining 5,000, a 25% chance of gaining 10,000, or a 5% chance of gaining 100,000. These are, if you wind down, you decide to invest 100,000. The graph below represents the best and worst case total value after 12 months. So A has a lower return but lower downside. E has a higher return but greater downside.
So that text is easier to read. Yeah,
And you just pick the portfolio.
pick the one that works for you.
Ganesh, pick randomly, just to show it.
When you hear that an investment has risk, what comes to your mind first? A high chance of losing money, uncertainty, opportunity, or exciting experience? Generally, I prefer an investment with little or no ups and downs in value, and I'm willing to accept lower returns these investments may generate. From September 2008 through to the end of November, stocks lost over 31%. What would you do after those 3 months? Would you sell all the remaining investments, sell some, hold, or buy more? Have you ever felt overwhelmed by your financial situation in front of 100 of your closest friends? Would you prefer to receive $100 today or $110 in 1 month from now?
Hey, how many questions? How many?
How often do you make impulsive purchases? How often do you make impulsive purchases without considering long-term financial goals? Do you find it difficult to save for long-term goals? I am more concerned with avoiding losses than achieving gains.
I'm sorry by mistake I gave a normal one. The 7 question is for fun, but I gave a normal one.
Do you rely on credit for everyday expenses? Okay, and submit. So if you can just sort of follow, that's quite a comprehensive, that's simply looking backwards, and it's quite comprehensive. This is not designed for somebody who wants a quick. We have a really short version, which is just risk tolerance.
Can you check the internet? It's not like
Ushot?
So let me tell you a little bit about the report while we see how technology. We will find out where risk tolerance sits, and we'll also say typically somebody who's like you for risk tolerance will have this mix of assets in your portfolio. We will look at your personality, and you would have seen in those questions all of those ones in the middle where answering in the middle is what you'd hope your chartered accountant would do. And you know, the interesting piece is advisors and their clients are often the same personality. If you've got a risk-tolerant advisor, they'll push their client to take more risk. So you would want a conservative, if you went into financial, I'm guessing, would be fairly conservative. So the personality pieces come out, 2 reports. One report is for the client, and the other is the prompt report. And the prompt report is basically, these are the questions for further revelation. What questions to ask. If you're in a technology world, then that information is going to be invaluable in the way you talk to the client in the future. If you're just a personal advisor, before the client comes in, you just remind yourself whether this person is open or conscientious, just to say before you come in, so it reminds you what you're dealing with. So here you see at least the first half of the plan prompt suite.
Yeah, it's okay. I think we have some internet issues. So what we can do is,
Simple thing.
no. I think we have a time constraint here. So what we can do is like, you can that answer thing like for the members here, like, we can circulate just to get a sense. So yeah, Paul, Shikhar, thanks so much for being amongst us. Like, so I would like to call upon Ravi sir, Mr. Ravi, Mr. Om Prakash.
No questions.
Illa. No, I'll tell you. We'll take the questions offline, or we have high tea served outside. This I'm doing in the interest of time because everybody seems to. I'm getting messages here. That's why. So we'll probably do a talk on the sidelines. Both are available. We'll collect over high tea. Mr. Om Prakash sir, we'd like to thank them. Ravi sir. Thanks, Paul. Yeah.
This is India. Something very useful. There you spelled my name right.
Yeah.
Good. Thank you.
Yeah.
I love it.
Sir, it's got a new one. Shikhar. Ganesh. Can I request Ganesh to come in for the vote of thanks?
Good evening, everyone. I think it's pleasure to see so many faces after seeing this questionnaire. To have an individual, experience of how to do an investment, understanding of psychology of investment understanding is a great experience. I thank Paul Resnik for taking his time and coming and presenting his wisdom. At the same time, I also thank Shikhar for being with us in this evening and giving his wisdom on the portfolio management. And I also thank the BCCI and also the Banking and Finance Committee for coordinating this effort, and also all the members and dignitaries present in this all. And I thank for your time and being with us. Thank you all.
Yes, please join us for high tea just outside, and I think we can continue the Q&A at the tea. Thanks so much.